You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options. Facebook.com/TheOptionsInsider or via questions at TheOptionsInsider.com.
It's time for Volatility Views, the premier program for volatility traders. Each week, we'll take a deep dive into the world of volatility with in-depth analysis, trading activity reviews, strategy breakdowns, cutting-edge education, and much more. We'll also bring you exclusive conversations with the traders, researchers, and asset managers who are reshaping the volatility landscape. If it involves volatility, then you'll find it on Volatility Views. Volatility Views is brought to you by Russell Investments, home of Russell Indexes, which calculates approximately 700,000 benchmarks daily, covering 98% of the investable market globally, including more than 80 countries and more than 10,000 securities. Approximately $4.1 trillion in assets are benchmarked to the Russell Indexes. For more information on Russell Indexes and RVX, please visit russell.com/indexes. And now it's time to take a deep dive into the world of volatility. It's time for Volatility Views.
All right, everybody, that song means it is time once again for Volatility Views, your premier program for volatility traders. My name is Mark Longo from the OptionsInsider.com, as well as from the ever-expanding, ever-exciting Options Insider Radio Network. I'm beaming to you here from the flu-infected studios of Options Insider, so hopefully we make it through the show no problem. It's been a fun week, been a challenging week from a logistical perspective, as one by one, everyone seems to be getting struck down by whatever horrible contagion is sweeping through Chicago here. Hopefully you guys at home listening are safe and healthy and doing the Purell and the hand washing and all that fun stuff. And of course, we have quite a few episodes on the old archive of Vol Views as well. Where can you find those? Well, of course, theoptionsinsider.com, the mothership. You can find all of our 13 programs there, as well as iTunes, Stitcher, AHA Mobile, even our mobile app. We baked all that goodness into one app for you. I know a lot of you guys like to use that and send us your questions and comments through that as well. It's all lots of good stuff baked into that app. Put it on your device, take it with you on the plane, on the train, wherever you like to listen to your finer podcast programs, and we can fill those down hours for you with some interesting and perhaps informative content. All right, and joining me on the old program today, first off, hot off his trip away here, his trip back from the hot zone that is Chicago, none other than Mr. Andrew Giovinazzi, beaming in from the relative safety of the hinterlands of Maine. Mr. G, welcome to the show, and congratulations on getting out of Chicago intact.
Exactly, without catching Ebola, basically, the whatever influenza.
Certainly seems like it.
Golly jeepers. No, just trying to keep up with Sebastian for 5 straight days, which you know how difficult that can be sometimes. Yeah,
those 6 martini breakfast, lunches, and dinners will catch up with you after a while.
Actually, after about the 18th martini per day, you start to get a little tired after like day 3.
Well, of course, you were also in town for the Big Options Alliance shindig, and listeners, I know a few of you were there as well. Thanks to all of you guys who showed up. It was a fantastic event. We look forward to doing it every year here with our Big Options Alliance crew. If you didn't have a chance to make it, you couldn't make it to Chicago, couldn't attend the event, we're going to have the media from the event, so the videos and some recordings up on that site, optionsalliance.org, very shortly whenever they're done being cut together, sometime in the next few weeks. So keep an eye on that site. You can catch up on anything you may have missed at the Big Options Alliance shindig this year. And also joining us from parts that are not Chicago, which means he has a chance of remaining healthy, at least for the time being, Mr. Jared Woodard from BGC Partners. Jared, welcome back to the show, and hopefully your little ones, unlike mine, have escaped this horrible contagion that is wreaking havoc upon society.
Yeah, everyone's doing okay in my neck of the woods, and as always, I'm really glad to be with you guys.
All right, sounds like things are hot and cooking over there at BGC Partners, which means it's time for us to get cooking as well with the show and dive right on into the Volatility Review.
It's time to break down the latest developments in the volatility trading world. It's time for the Volatility Review.
All right, everybody, welcome to the Volatility Review. You know what this portion of the show is about by now. This is the portion of the show where we look back on the week that was from a volatility perspective. We'll kick things off in the land of VIX and the VIX Cash, as we are wont to do, and has been a bit of a inexorable climb week for the VIX Cash. Started off the week hovering right around the mid to low teens range, right around the 12.5 range in the VIX Cash land. And as the market continued to sell off, the VIX continued to eke its way north throughout the entire week, got to a high of a little over 21 intra-session today. We are recording this Friday, listeners, December 12th, for all of you playing the home game. It has since come off a bit from that high intraday, is now trading just a tick under 20 these days. So VIX Cash having quite the range, quite the movement from a vol perspective this week, which is kind of interesting. The underlying index is also having some interesting developments out there as well. So a lot to parse, a lot to chat about on today's show. Perhaps we'll start with you, Mr. Andrew, since you have been hither and yon all week. You can give us your not globetrotter, but perhaps nation trotter perspective on what caught your eye from a volatility perspective this week.
Range in volatility was pretty big. I guess that the simple thing, anytime it feels like you got three extra market factors at once, vol tends, I feel like that's been the pattern over the last, 20 years. You've got Congress is dithering about the budget. I guess the House passed something, but the Senate's supposed to this weekend. So there could be, there's that Congress still that can't do its job like normal people. Like you have a budget at the Option Insider Radio Network. You pass the budget. Congress, of course, still, everybody has to make hay out of something. But anyway, it causes volatility. You have to, this Greek snap election where, that ex-communists want to come in and try to take some control and shake their hands at the Europeans. That is potentially destabilizing, mostly, with some of those Mediterranean bond yields below Treasury bond yields, which just absolutely blows my mind how that could exist, but yet it does. And lastly, you have the continued fall in oil prices. And I think the reason for the vol is the market likes certainty. Even when oil was at $100, everybody knew that it was $100. And as it's starting to plumb below 60, it's kind of not finding a bottom. A lot of third world countries depend on oil exports. Those third world countries have, bonds, high yield bonds, whatever, emerging market bonds. That starts getting those bond payments. People start getting a little freaky about that. There starts to be a little selling there. Now all of a sudden you get a little selling somewhere else. You're having some destabilized currencies like the Russians basically are on their way to going to zero. Apparently their market's down like 60% or something from the highs this year. It's a pretty big drop. So you've got these factors together and all of these things add up to a little more volatility. Everybody's, Russia's almost down 50% from the highs this year. And all these things together drive volatility higher. And what it really does is it makes the sellers of juice go away. And volatility or options just start to grow because you're running out of sellers and up and up and up they go. So it would not surprise me to see volatility go higher, and it wouldn't surprise me for, especially after the weekend, Congress doesn't do something or oil gets lower or, something more unstable happens out of Europe. But, the underlying economic news here is still pretty good. But there's that, like we had kind of in mid-October, there are all those worries, like we're worried about Ebola and we're worried about the EU is not going to cut rates, and it seems like when there's one too many, vol goes up, because we're having a market move, but we were down 1% today, and VIX jumped to 20 and change. So I think the vol move is outpacing the market moves so far, and it's mostly betting on some other sort of market moving news. Now, what I will say is, since we were just at relatively high prices for the SPX, vol certainly gets there, VIX gets there when you get to when the upside's in play. We trade at 2075 in the SPX, which is 50 handles. So all of a sudden everybody's like, well, if nothing really happens, we're going to bounce back again. So it's putting in motion like the moves people are expecting are now in that order of magnitude 3-4%, which is enough to make VIX trade 20. And I think that's where we find ourselves today.
Interesting. A nice roundabout way to get back to where we are today. Well done, sir. You mentioned a lot of topics that I think we're going to get into in a lot more detail. Of course, oil. We could probably spend the whole show on oil. Oil south of the 60 handle. Crazy town. That's pretty much the only technical term you can use to describe that, I believe, at this point. And we'll certainly dive into that in more detail in a little bit. You also touched on the spending bill. We touched on that a little bit yesterday on the option block program as well, because unlike just from the pure macro perspective, the way we usually address it, because that's usually how it impacts us, there actually is a bit of a derivatives corollary this time, is because that's what held up the spending bill, was how they're going to treat the proprietary trading desks at a lot of these big banks, if they're going to continue to spin them off, or if they're going to loosen that language a little bit. There's a lot of push and pull on that issue. So it does come back home to us. Of course, that was a topic we discussed very recently on the show back in October, when the markets were really moving, but still somewhat thin, and there was a lot of talk about whether the thinness in the markets and the exacerbation we were seeing as a result of that was a direct result of these prop shops and these prop desks being pulled away from the banks. So we didn't have the usual players and a lot of the OTC products, as well as the listed vol products and listed large institutional products like SPX and others, and that could have exacerbated some of the moves we saw, particularly back there in that October period when things were really, really moving and shaking. A lot of things for us to sink our teeth into. Before we do that, I shall turn it over to our other volatility compatriot, Mr. Jared Woodard, who's hot in the middle of the action over there at BGC Partners. Jared, what caught your eye in the week that was from a volatility perspective?
Okay, three things that I would want to mention here. I think this question, just in terms of the news cycle, the real details of the legislation that almost shut down the government, I think, were so comically small that no matter what your political or ideological view is about the role of regulation in markets and any kind of substantive view, the likely impact of this legislation was so small that it was kind of comical that it really came to that. The products that we're talking about here are a relatively small portion of the OTC market. Interest rate swaps, other very, very active products, currency. A lot of the things that banks need to use to hedge loans and other core parts of their business, Dodd-Frank allows them to stay within the legal entity, the bank holding company that has the implicit backstop and FDIC guarantees and so on, and that's never been at stake. And so what was talked about being pushed out here was relatively small, bespoke, customized products, and a very, very small sliver of the OTC market. So whether you thought this was a great thing or a terrible thing, I think that the consensus among some folks was that it was just a comically small piece of legislation to be getting all worked up about. The second thing
when the D word is invoked, though, Jared, that's when people get very much in an uproar.
Oh, this was a fantastic. If you're a connoisseur like I am of coverage that trades in scare tactics about evil, complex, exotic derivatives. If you enjoy in a kind of a spectator way some of that coverage, this was a fantastic week for you because basically everyone involved, with the exception of one or two industry publications that I follow, everyone else just sort of went onto the evil, scary derivatives bandwagon without really getting too bothered about the details of the legislation, the likely market size or impact, or any of the real guts of what was at stake.
Not to cut you off, I've always toyed with the idea of adding a program to the network that analyzes options and derivatives coverage in the broad financial media and parses a little bit. I haven't pulled the trigger on it yet because precisely it would pretty much be a one-tone, one-note show. Oh, they're evil. Oh, they're evil. Oh, they're evil. There wouldn't be a lot of variation to that show, so we haven't really launched it yet. But it's something in the back of my mind. I would like to look into that someday. If I could ever find...
I mean, I won't belabor the point, but I mean, I think there is real room for more understanding on the part of the public about the role that financial products play to help end users, people who have certain risk exposures that they don't want, offload those exposures the same way that you or I buy auto insurance or health insurance to offload particular risks that we just aren't capable of or don't desire to hold. We use derivatives so that companies and others can offload risks that they don't want to hold. And I think that there's been such a massive failure on the part of the industry to explain the value of these things to people that as a result you see the kind of reaction in the kinds of news cycles that you did today and all this week. But moving on from that back to the markets, I think there was a couple things that caught my attention this week that are also kind of guiding my outlook for next year in two places, both in VIX and listed VIX products, and also in the high yield market. We all know the oil story, and we've been all following that pretty closely, I think. But what really changed for me this week was the reactivity in VIX options as investors felt more pressure from equity returns. Usually it takes, the big stat I think that deserves a lot of attention is the change in the implied vol term structure, the sort of relationship between say at-the-money options with 1 month to maturity and 6 month maturity, or you can look at 3 month versus 1 year. But the shape of that curve and the speed with which it changes, especially the speed with which it moves towards a kind of a flat level where 3 month and 1 year options both cost roughly the same. That's something that is pretty technical to look at, obviously, but it's also very revealing about the speed with which investors pile into short-dated premium and the speed with which their risk tolerance kind of evaporates. And what we saw this week was that the pace of change on a weekly basis at different ratios you can look at in the term structure was one of the fastest we've seen in a long time. And if you adjust that for the size of the move in the equity market, it looks even more extreme. And so that tells me that investors have become increasingly risk averse, even when, it's almost paradoxical. The economic fundamentals are so strong. Retail sales have been so good. Consumer confidence today was so strong. And at the same time, equity investors seem to be getting increasingly skittish. Two other things I'll point to are the volatility of vol, the VVIX index, widely followed among other measures of vol are also surged to highs. And I think that explains some of the first order reaction in VIX. When vol is itself very volatile, it becomes harder to hedge and to trade SPX options and VIX options. And so I think that explains some of the move. But the fact that volatility itself has been so volatile is something that deserves, I think, quite a lot more attention. And then finally, moves in the high yield market, which have been a big theme in a lot of coverage this week. I was looking at JNK, which is one of the most widely traded junk bond ETFs, and on this day on Friday, December 12th, the spread between the price of JNK and the net asset value of the ETF was one of the widest levels over the past year. I think the only wider level was what we saw in the depths of the market down move in mid-October of this year. So that's the level of stress that we're talking about, the level of demand for sort of exits and liquidity among investors.
I got one question for Jared too while we're here. Haven't you noticed just the total evaporation? I'm just following these ETFs too, and mostly because we do it on the Oddity Show. I'm just seeing huge put buyers in like HYG, EMB, and they have been really right over the last and all of a sudden, all these ETFs are just falling off the map. And I thought that was part of what was causing some stress, or what's happening in the underlying securities is, going back and causing stress in the ETF. But I'm like, it's kind of, sometimes the bond market is the dog and the equity market is the tail a lot. And it feels like some of this unsettling action that's, the ETFs are just, cover a small portion of it. But I feel like this is trying to give us a little sense there of, I think there's a lot of worry about what the Fed's going to say next week, that they're going to actually maybe start to raise. And it's causing a little bit of nervous action right now. And it's sort of percolating through these sort of vanilla products. What do you think?
I think you're right. And I think, too, that people have come to realize that liquidity in the secondary market for corporate debt is not what it used to be, and that it's not probably what, especially folks who trade equities and ETFs are certainly used to. I mean, I think that a lot of investors have accumulated corporate bond positions that they needed to meet mandates, to meet benchmarks in years, and faced with the prospect of selling those at really awful prices. Just anecdotally, they may be opting to sell some, take profits on some equities, or sell the, ETF instead, sell the high yield ETFs instead. Especially if you think of yourself as having let's say you don't think this is some kind of a major market correction, but just a short term hiccup, and you expect the spreads on your bond positions to narrow, you expect returns to come back. Well, it would be terrible to sell at this point, especially in an adverse market from a liquidity perspective. And so I think that there's an incentive for people to seek liquidity in places that are maybe decent proxies or decent hedges, rather than selling the underlying assets themselves. And if that's a true story, if that's a plausible story, then that would explain, I think, some of the spread to net asset value that we just talked about in the ETFs, and it would explain, I think, some of the transmission of risk into equity markets this week, despite otherwise, as I say, truly fantastic fundamental data.
You're right. There has been a lot really cooking in a wide variety of markets. And you mentioned earlier, Jared, some of the volatility metrics showing the skittishness of the broad equity market and the broad equity populace. Surprisingly, or maybe perhaps not entirely surprisingly, looking here while you're talking at the skew index for the SIBO, and it's not perhaps as high as one might think. Of course, some of that has come off recently from the recent sell-off we've seen in the broad marketplace. So when you factor back in the recent high that was set, I believe, back on the 9th of Tuesday, which is right before the big sell-off began, the skew index hit about a 137 or so high. Now it's trading right around 130. It's between 130 and 131, kind of vacillating around a little bit. I say trading loosely, using the loosest term of that. It is being disseminated at that value. But essentially, so there was a little bit of a market increase in concern earlier this week, this sell-off having taken some of it off, as you probably would expect. But still, overall, the skew index perhaps not as high, not indicating perhaps as much overall fear as you might consider, given the other circumstances going on in the marketplace. It has been a weird one to watch. We're kind of right now, actually, if you look at a one-year chart of this index, we're kind of right in the middle of that range. We've seen some vacillations to as high as right around 145 or so back in mid-September, and some drops down to around 110. Of course, that one weird kind of aberration drop right in the middle, October, when the market really took it on the chin. And of course, you're going to see that skew come in as a result. But aside from those weird kind of aberrant moves, we're kind of right in the middle of where that range has been over the past year. So interesting to watch. I think a lot of people might have been expecting skew to be exhibiting perhaps even more uncertainty than it is currently doing right now. Talking about the implied vol of the S, of course, the VIX product has been a pretty robust week overall for that product as well. Like I said, we are recording this right around 1:30 p.m. Central Time right now here in good old Chicago, so right in the middle of the session, and we're already pushing about 1 million contracts out there, over 1 million contracts today in VIX already. So this is clearly a banner day. Of course, the markets are selling off a bit. We're down about 0.75 of a percentage point in the S, a little over 1% in the Dow, and just fractionally in the Q. So there is some momentum driving that volume. The rest of the week has been fairly heavy as well, about 800,000 contracts on a lot of days, with a couple of early days of light volume. So some fair amount of action going on in the volatility space, despite the fact that a lot of people, us included here on the show, predicted primarily quiet markets going through the bulk of December. Not a lot really on the radar, except for apparently oil, surprising everybody. What we saw, talking about the hot strikes, the things people were really interested in out there in VIX land over the past week, well, the number one hot position Surprise, surprise, this one actually looks a little prescient in hindsight, of course, are the Jan 20s. The call side lighten it up pretty near term. This was a fairly aggressive level just earlier this week when I said the VIX was hovering right around the low teens. This was a fairly out-of-the-money position. Now, of course, hovering right around the at-the-money level, depending on which future you're looking at. About 305,000 contracts open on that strike, so fairly robust volume there. And then we get to the puts, number 2 and number 3, which is kind of interesting as well. 270,000 of the D's 12 half puts, and then the D's 13 puts, a strike we've talked about quite a bit, continues to have a lot of resilience there at 253,000. Then we drop off quite a bit to about 200,000 for the D's 20 calls, and 184,000 for the D's 25s, 181,000 for the D's 18s, taking up the number 6 spot, and then 181,000 the D's 11 half puts. I believe that's the first time we've seen that strike coming up here on the list. Number 7, interesting. So some puts lighten it up here for a change. The D's 23 calls with 171,000, and then rounding up number 9 and number 10, the D's 19 calls, and the D's 14 puts with about 145,000 open each. Total open interest off a wee bit, a little bit better than it has been, though. It was about 5.7 million when we talked last week. It's about 6.6 million today, about 4.3 of those coming in the calls, and about 2.3 million in the puts. So as we mentioned last week, open interest still off the average. It's been pushing for most of this year, right around 8 million contracts. So still off that, but certainly well off of rebounding from the lows it got right around the last month's expiration when I think it hit about 4.2 million contracts open. There was simply nobody playing out there in the vol landscape, and that narrative has certainly shifted a little bit. I'm certain today's 1 million contract volume will feed into that as well. Shifting gears a little bit into the shorter end of the spectrum, the shorter term end of the spectrum, of course, VXXT, the near term VIX product as well, also doing a fair amount of volume this week, having a couple days. The 10th, of course, about 2,500 contracts. That's fairly decent volume. It still is a weird animal, though, because you have a day like the 10th, which was Wednesday, I believe, and then you have a day like yesterday where you do 2,500 contracts on Wednesday, and on Thursday you do 3 calls and 4 puts. So I'm not sure still what to make of this product. And so far today, on the 12th, when you have a day when the VIX mothership, the VIX actual options are trading over 1 million contracts just halfway through the session, you have this product doing 300 contracts today. So I still really can't make a head or tails of what's really going on out here in VXST, what the catalyst is, what people are using it for, what sparks a 2,500 contract day versus a 7 contract day. It still is a weird beast. The hot strike out there are the D on the 17th, the December 17th expiration cycle here. The 17 calls are 2,050 open of those. Then we drop off to 1,400 of the end of D, December 31st, 13 puts. And then on the 17th cycle, again, 1,000 each of the 15 calls and the 15 puts. Maybe there's a straddle on the 15 strike out there in VXST. Then it kind of drops off from there, with the number 10 spot being about 100 of the 40 calls out there on the week of the 24th expiration. So someone is apparently still somewhat optimistic. The VXST hovering right now, listeners, at about 22.5. So that's a fairly robust overall expectation if that is indeed a opening long position. About 7,700 total open interest, so still fairly decent open interest. About 5,100 in the calls, about 2,500 in the puts. So that breaks down kind of like the VIX mothership there, but still an odd duck. Really hard to predict when it's going to knock it out of the park and when it's just going to sit there and do almost literally nothing. How do you go from 2,500 contracts one day to 7 the next? I don't really know, but if you have a guest, listeners, I'd be curious to hear it. Send it in. Questions at theoptionsinsider.com, or just find us on Twitter. We'd love to hear your insight as well. Speaking of insight, Jared, I know you spend a lot of your days looking at not just what's going on here in the domestic markets, but also what's going on beyond our fair shores in some of the international volatility markets. Anything catching your eye out there over the past week?
Yeah, I think that the attention has actually focused towards a commodity story, and so for once, international challenges are not as much on people's radar this week. Although I have to say there was some pretty disappointing news from an economic standpoint earlier in the week. The German current account surplus in their balance of payments came in at the highest level I think ever, maybe second highest level, and just kind of further cemented the view that Germany's not interested in showing much in terms of economic leadership for the monetary union as a whole. As a result, I saw a number of analyst growth outlooks for the next year for Europe kind of kept or ratcheted lower, and corresponding volatility outlooks kept where they were or ratcheted higher. And so, I mean, there's not that much that's new in the bigger picture, but it's certainly not a great outlook as those imbalances continue across the continent. I think that really is driving market perceptions much more than the kind of positioning and liquidity that we're seeing in the U.S. I mean, there's certainly the European Central Bank is on everyone's minds and whether they're going to, and the scale in which they might begin asset purchases in January. But as I say, I think that the economic imbalances on the continent are actually the biggest driver of all here. Japan continues to struggle. The data this week was not particularly encouraging. And so that's kind of been reflected in the currency and in the equities. There were also some barriers that were hit recently in yen options that I think caused a bit of a shuffle that people who weren't paying attention to those over-the-counter products may not have expected. But as I say, otherwise, I think that the attention has been so focused on oil and on the U.S. This week that, especially with the Fed coming out next week, there's not as much news that I've seen anyway for world markets in terms of volatility.
Well, since everyone has touched on the commodities, in particular oil, let's just dive into that. I'm sure a lot of our listeners are saying, oil, yelling it into their speakers, so we'll get to it. It is, of course, there has been stuff going on in the broad equity landscape, but oil is certainly where a lot of the mind share, where a lot of the activity and interest and certainly volatility has been over the past week. You know, if you had told any of us, probably on this show or on our Futures Options Roundtable or other programs on our network a week or two ago, maybe not a week ago, but certainly a couple of weeks ago, that when we were hovering in the mid-70s or certainly when we were back in the low 80s and everyone was discussing, well, it seemed like the lion's share of the bearish sentiment had kind of been spent and it was kind of silly to have all this premium in the downside crude puts. Well, certainly we've all been proven wrong. We had talked recently on a lot of our programs that 70 seemed like the strike that OPEC was going to step in and defend at, and so that was kind of pulling the volume and the underlying down to that strike. But we're since well south of the 70 strike, having broken through the 60 handle since the last time we gathered together here on this program, which is just, I think, crazy town is pretty much the best way to describe it at this point. And not surprisingly, we're starting to see, because the fulcrum have shifted so much, we talked a lot in earlier episodes about how that oil skew was just looking like an equity. And that made sense when we were up in the 80, mid to low 70s, and there was still a lot of premium on these 60 handle and somewhere in this range kind of puts. Now we're down at that level, so we kind of depressed those a little bit. And as a result, we are starting to see a little bit of a lift coming in to some of that call wing, which is the first time we've seen really a market increase out there in a while. We've seen little flurries of interest, but now, you know, when we're starting to get so far down the chain here, it's just almost academic at this point. You're going to see some interest in the upside. We were talking to the folks over there at Options Express yesterday on an Option Block show, and they were saying actually the lion's share of their futures options activity in the crude yesterday was on the upside. So they were seeing a lot of people coming in and scooping up 90, 95 par calls, and we're seeing similar activity lighten up here. The skew, the par call, the par strike, not surprisingly, kind of a round number, seems to be a hot one. In fact, I believe that's still one of the heaviest open interest strikes out there in the big crude, no matter which one you look at. It's a lot of it is legacy paper, obviously, but there is still a lot of open interest on that par strike out there. And it still has been just a crazy, crazy time to watch oil and all the interesting trades that are going on out there. Of course, there also was an interesting piece going on out there in Bloomberg this week. We touched on a little bit on Option Block yesterday, but I'd be curious to hear you guys' opinion as well. Kind of comparing and contrasting the flow they're seeing out there in USO, which is, of course, a much maligned, at least on this program, ETF that attempts to mimic not oil itself, not crude itself, but really kind of more of a basket type energy product. But it does reflect what's going on out there in crude, as well as XLE, another ETF that we've talked about a lot out here, and how the implied vol has spiked, as you might expect, out there in USO, that kind of moves in lockstep with what we've been seeing in the big crude options. We've also seen a heavy preponderance of activity in the puts, as you would expect, given what we've seen in the big crude oil options, and also seeing that reflected in USO. But surprisingly, not as much so in XLE. In fact, the puts are still relatively light comparatively to what we've seen in USO, a much lower put-to-call ratio out in XLE, which is kind of interesting. And also the overall premium out there is still fairly light comparatively, certainly when compared to USO. We did the analysis yesterday. I believe it was about a 50 for some of these 5 to 10% out of the money puts out there in in USO, a 50 vol versus a couple months out versus about a 38 implied vol out in some of these strikes out there in XLE. So the vol is lower. The puts are getting less action, which is interesting. So it seems almost like there's a different use case for that product, which is a little bit interesting as well. So a lot to sink our teeth into there on the crude spectrum. Maybe, Andrew, we'll start with you. What, if any, of those topics really caught your eye? Maybe something else entirely caught your eye out there in the crude USO XLE landscape over the past week?
I thought, I wrote in our blog a couple weeks ago, I thought the trade was just to be short oil and sell out of the money puts in the individual energy companies, because you could buy put spreads for not a lot of money because of the skew, and the vol's super expensive in all the energy producers. And you could essentially have your oil puts spreads pay for, quite a bit of your other positions. So, and it worked out as a good trade idea. But, the thing is oil, the commodity, feels like it can really slide, and it's also easier for people to digest. The more popular product would be oil, so they're just going to keep buying puts in it while it goes down. The energy producers maybe are a little harder to, let's just call it, understand as far as that goes. But the vol's pretty expensive in there. It's just, these are still companies, so they trade fundamentally a little differently, right? They still have cash, they still have assets. So I think they're just going to trade. And at some point, if they're way below book value, that's going to attract some fun buying at some point. Oil, what's the value of a barrel of oil? Who knows? Today it's 65, tomorrow it could be 55. So I think just the products trade a little bit differently, and I think that might explain some of the vol skew on them.
Mr. Jared, what caught your eye out there? A lot to obviously parse and chew on out there in the crude landscape over the past week.
Yeah, one thing, I don't know how well this has been appreciated, but I was looking at returns over the past decade and a half, just to get a sense of how the scale of this move in price. So if you look at just week over week price changes in crude oil futures, the kind of rolling 1 month future, the 1,000. The returns that we saw 1 week in late November and then the most recent week are both well beyond 2 standard deviations of what a normal curve would imply in crude oil terms. And so that in that context, given the scale of the move, it's hard to argue. I think that the options market in crude oil has actually reacted incredibly poorly. In fact, it's been more that we've seen. And I have to say here, actually, check on our collective skepticism about some of these ETFs. If you just regress values of USO and a 1 month crude future over the last year, the R squared, the square of correlation since this time last year has been almost 98%. So we can argue about what the appropriate metric is to measure crude oil, and maybe the first month rolling future is not the correct one. I don't know. But what I do know is that the USO does seem to track that metric pretty well, and so there's, I think, plausible cases for why investors should be aware of the oil term structure, just like they are in any other product. But with that said, I think Andrew's point is exactly right, that there's some real value in energy equities that is never going to be reflected in the commodity price, and that we may be be approaching levels where those are attractive. I noticed that on this session, while crude is at new lows, there's a lot of individual energy names that have sold off only mildly, if at all, and some of them, like Transocean ticker RIG, has actually slowed its decline in a pretty smooth fashion over the past week, and so we may be reaching levels where a lot of these companies have hedged themselves pretty well. I know that the ExxonMobil put out a statement late this week that these moves were actually still within their long-term forecasts of what their stress tests for different exploration projects would allow. And when you combine that with the hedging that they do when they have tactical chance to do so, you may be having an opportunity here to start getting into some of these names where there may be some value.
There you go, Jared, leaping to the defense of USO. Unfairly maligned, he says here on this program. So there you go. There you go. The USO Defense Force in full gear, full standing here on the show today. Thank you for that, Mr. Jared. You're right. We do malign those on a regular basis. It should be some people standing up when they do perform somewhat as advertised. Someone should point that out. Speaking of pointing things out, I'm looking here while you were talking. I was just pulling up some of our old skew charts from recent shows. I pulled up one from about a month ago, October 10th, looking at the skew chart out there in the American crude, and we were hovering right at the time right around an 85 in crude on the crude handle, so well north of where we are today, and we were kind of laughingly joking. The at-the-money vol was about somewhere in the 20 to 25 range, depending on which future you were looking at, the options on it. And, of course, the downside puts were trading well into the mid to high 20s, if not almost into a 30 level. You're looking at like a 70 handle or so put, which is, of course, a deeply in the money put. Now, that seemed pretty extravagant at the time. And, of course, fast forward a month, or the at-the-money vols out there in crude are hovering around a 40 now. So you did well there. Of course, if you bought that 70 strike put, whether you did it straight up for a spec or whether you did it on a adjusted vol basis, we're trading in a 40. I said those puts right now are actually, in some of these other puts, are trading right around in a close to a 50 handle out there in some of these crude options. So you made money on a pure vol basis. You certainly made money on an underlying basis. It was a pretty much of a home run trade, despite the fact that it didn't really look like it was shaping up that way about a month ago. It seemed like the worst was over. It seemed like a lot of the interest in those puts was kind of just getting into the crazy tinfoil hat territory. Certainly OPEC would step in somewhere around 70, and certainly we were all proved dramatically and demonstrably wrong, which shows how fickle and also how interesting some of these commodity markets can be on a regular basis. All right, that's going to do it for the old volatility review. I might make sure we have some time still for you guys to join us on the old show. So without further ado, let's dive right on into the volatility voicemail.
It's time to share your thoughts and opinions with your fellow volatility traders. It's time to check the volatility voicemail. Make your voice heard by dialing 779-669-4VOL. Posting a comment on the optionsinsider.com, sending an email to questions@theoptionsinsider.com, or posting your questions to twitter.com/options or facebook.com/theoptionsinsider.
All right, everybody, like the man said, this is the portion of the show where you guys get to join us on the old Volatility Views panel, make your questions and comments known, not just to us, but to your fellow listeners out there. Going to kick things off with a question from C-Punk. He writes, "Hello, volatility gurus. Long time, first time. I love your discussions of all things volatility, particularly your breakdowns of the different products. I listened to your episode with Scott Nations recently. That was about a month or so ago, listeners. And it got me thinking about how most volatility products appear to be very flawed. VIX has obvious issues, and the Voldex products doesn't appear to solve many of them beyond eliminating skew, a point which I might add we brought up on the show with Scott. An interesting idea, but it pretty much just VIX without the skew at that point." Mr. C-Punk goes on to write, "The various ETPs all have very well-known issues as well." Again, something we've illuminated many times on the show as well here. Mr. C-Punk goes on to write, "If I had to think of an ideal volatility product, it would probably be something along the lines of what your former sponsors, Volex, promoted, a product that essentially captures the actual volatility in the marketplace. I'm not familiar enough with the underlying mechanics of their product to analyze it, but I think we need more products in that vein that attempt to deliver the actual volatility in the marketplace versus some some vague guesstimate that is probably wildly inaccurate. Do you agree? If you could construct your ideal volatility product, what would it be? I think maybe Don Schlesinger is writing in under a pseudonym here. No, I'm just teasing. That's a good question here, Mr. C-Punk. I'm sure Don will be happy to hear what you had to say. And you're right. That's one of the reasons we worked with them on this program for so long. We found their approach to the volatility market, and indeed just that general, taking away from Volex for a second, just the general approach of realized to be much more compelling for a wide variety of the audience out there, because so many people follow your line of logic there, C-Punk. They come to VIX for a variety of reasons, whether it's the marketing or beating the drum on CNBC. They hear about the Fair Index, think that sounds kind of cool. Maybe they hear about it from their broker. Whatever the case may be, they come to VIX, they start trading it, and inevitably, a month or two, 6 months down the road, a year, whenever the case may be, they inevitably hit that point where they say, wow, this product actually has a lot of flaws, and I would like something that does X, Y, and Z. And usually that X, Y, and Z usually involves somehow capturing the actual volatility of the marketplace, not some of these weird guesstimates like you point out that could be wildly inaccurate. So you're reaching that point that a lot of our other listeners and a lot of the users of these products eventually reach. They want something else. Again, you're kind of right. The Voldex doesn't seem to really solve that aside from eliminating the skew. So if that's your issue with the VIX, that certainly would be a helper. I'm kind of torn, though, on what my ideal product would be. I would certainly probably want to include that realized component. I also think if I had to think of what would be helpful to the broad spectrum of volatility traders out there, including a lot of these retail who keep getting sucked into a lot of these ETPs, what they want is a product they can essentially say, hey, I think the VIX Cash is low here. I want to be able to buy that and kind of buy and hold it in my account and have it without any sort of demonstrable negative impact like I do when I'm buying a VXX or others. So I think if you can, that's kind of what the Whaley folks are working on, actually. No one's ever seen it in actions. We can't really speak to it, but something that combines that, a realized volatility, with also allowing retail to, without a large, substantial effort, having to go out and dynamically hedge straddles and things, to actually be able to buy and hold VIX on a regular basis without being demonstrably negatively impacted by that roll yield, I think would be a fantastic thing that would do a service to a lot of people out there who are currently buying things like VXX without really any real understanding of how they worked, and they're getting hosed as a result. So I think my ideal product would fall somewhere in that realm. Mr. Jared, what do you have to say here for our friend Mr. C-Punk's analysis, as well as what your ideal volatility product would be?
Yeah, I mean, I kind of don't agree with the premise of the question that the existing volatility products are flawed. I mean, that's a pretty normatively loaded kind of a term. I mean, if you think that the time value of money is flawed.
Here we go. Time value of money again. I love it.
Well, I mean, look, it's just a basic point. I'm like, I can imagine an alternate universe where there's a fixed income podcast and folks are talking about, 10-year notes and how, gosh, if you 10-year note and you hold it, the roll down that you have to pay, the carry, if you're long or short, and the way that term structure of interest rate changes, it means that, gosh, there's all these hidden costs, and really all you use some hypothetical spot rate that someone calculated at some point. And of course, all the variables that make interest rate products move, I mean, some of those are exactly the same variables that make volatility products move and make the prices of options move. And until an investor understands what drives the changes in option implied volatility with the same level of detail that a fixed income trader understands what drives changes in futures and cash fixed income products. I mean, those products are going to look flawed because there's there are variables that aren't being accounted for in your mental model. So, I mean, it's hard to answer a question, what's an ideal product when the premise is that the things that exist are flawed in some way. I mean, even if we take the Volex product, which I like and which I think it has some really attractive features to it, I think it's important to note that you're still in that model. I mean, it's basically a listed swap, right? And so you're still going to inevitably be paying some premium above realized most of the time for the privilege of getting realized at the end of the period. I mean, if to continue on this kind of cantankerous strain, my ideal volatility product for someone who thinks that the existing suite of things is flawed would be no volatility products, by which I mean try to get exposure to volatility by just trading an option replication strategy. There's a great paper on this that explains this in plain language. I could send people at the site if they're interested. You can, if you have a portfolio of cash and your underlying asset, and I think you need a fixed income asset as well. T-bills usually does it. You can replicate the payout of a call option or a put option, and you can buy and sell short. Basically doing the dynamic hedging part of a familiar, hedge straddle or hedged option strategy, and replicate the payoff. But it's really expensive and it's really difficult. You're exposed to jump risks because, of course, we don't have continuous trading. And so all those kinds of risks and challenges that make that an expensive thing to do are embedded in options. The fact that we don't know the future is embedded in option prices. The time value of money is, all these things that go into that make life difficult if you actually try to replicate an option with just a cash market. And I think those are real costs, and they exist in options for very good reasons. And so to say that an option product or an exchange traded product that, sort of replicates the payoff of some options is flawed because it includes all of these very real world costs, to me, not to put too fine a point on it, but it betrays a lack of understanding of what's actually going on in these listed products. So I love innovation, especially in this area. And if anyone can replicate the spot VIX in a cost efficient way, more power to them, I guess. Although I don't see the actual economic value of spot VIX products versus what exists currently, to be honest. So, I think what's actually needed at this stage of the game isn't more product innovation. We have had plenty of that in recent years. I think what's needed is more understanding, and that once you have that, then the products will trade in a more consistent, stable kind of a way. And, of course, that's what we try to do on the show. So, big pats on the back to all of us, right?
See, now you know why I included this question, Andrew. Nothing gets Jared more riled up than a question that somehow involves the time value of money. I knew this would get his juices flowing, and it certainly did. That's his button for whatever reason.
I could feel his hackles getting in an uproar.
When it gets Jared off of the fence sitting and into the cantankerous mode, that it's a good question. And certainly I agree with you, Jared. I think at the end of the day, we would all be better served by having everyone in the marketplace actually understand what the hell they were trading. That would probably be a preferable route to tweaking the products. But in lieu of that, if I had to have my magical product that could maybe solve that on their behalf without making them go through that, then I would probably lean that way, because I think at the end of the day, the magical product, as ridiculous as that is probably still more realistic than the magical scenario in which everyone understands what the hell they're actually trading. I guess I'll take the lesser evil of the unicorn in the room, I suppose. Mr. Andrew, where do you fall on this very heated debate?
Well, what Jared was bringing up is a good point. Like, what a lot of people don't understand is also how to create liquidity in a product, right? So, how are you going to price realized vol? Okay, how are you going to make a market a realized vol when the realized vol of the S&P 500 is like 4? Like, what are you going to sell what's the 4-level strike going to be worth 6 months from now? It's just trying to find an underlying, trying to create the product, trying to create the demand for the product. It's not a total slam dunk of ease. I think everybody's used to saying, okay, well, there's a ticker and there's some volume and I'm going to go trade it. But, people have to make markets in these products and the liquidity has to be provided. And you have to create, what this underlying is going to do. And don't forget, volatilities are mean reverting products. So you're going to have liquidity at kind of different points in the cycle, knowing that, well, that 11 VIX is hard to break through, and how much, and there is a future value assigned to all that stuff. So it's not like just a clean product, because it's not what we'll just call an equity. It's not a vanilla product. The underlying forces that drive the value are not as easily touchable. Even though it's like, okay, volatility is higher or lower, it makes pricing and trading these things a lot tougher. So, what I would say is Option Pit was basically founded because people do not understand volatility. And I'm not going to say that trying to be egotistical. I'm just saying, you're a market maker for 15 or 16 years. I think you have a unique perspective on how volatility moves in liquidity. That's like a teachable thing. And, what we're finding is people come in, they have almost no concept of how it works or how it affects option prices. And it's I would say, it's one of the more important inputs in how things are priced. So once you understand how the products work, right, they're going to pretty much work once you understand. They're going to work, like we say with a lot of the vol products, they're reliably crappy, meaning we know how they're going to operate given a certain set of circumstances. And I think once you understand the circumstances of or the characteristics of a particular volatility product, they're a whole lot easier to trade and to understand. And I think that's probably the biggest problem is people trade them not really understanding what drives the value of the product. And, the hardest thing to tell people is, well, the VIX options, the VIX cash doesn't necessarily drive the value of the options. And it makes people scratch their head. It's just that's what it is. Because it's such a forward value product. And for the same reason why people maybe get bent out of whack that Tesla's trading, $220 when it barely makes any money. You have a mismatch versus what the underlying assets might be worth and what the market wants to pay for it. And the vol products, I don't think are a whole lot different than the perception on any other kind of speculative thing. So it just depends on, you got to just understand how it works. And once you do that, everything is a lot easier.
I love it, listeners. Good stuff. And keep those questions coming, particularly ones about the time value of money, because we want to push Jared's buttons a little bit here on the old program. Stay tuned for our upcoming episode all about the time value of money, in which Jared froths at the mouth. Unfortunately, that's all the time we have. I wish we can get into this a little bit more. That's a good question, good thought piece here for the old episode. We'll have to leave it there. And since we are kind of running long, we'll do a quick combo crystal ball / what's coming up in your neck of the woods. So, Mr. Jared, if you have calmed down a wee bit, sir, from that crazy business, what's coming up? First off, give us your expectation for these last few weeks of holiday, perhaps malaise or perhaps not, given what we're seeing in the marketplace, as well as what is coming down the pike in the land of BGC partners.
They had to tie me down over here, so I can't really move very well.
I can see the speckles of froth and the bloodshot eyes through Skype. It's terrifying.
I'd be surprised if the equity market doesn't calm down from here. One thing I noticed in the last couple sessions is that there's been some strength in the sectors that maybe are the most obvious places to look for it. Consumer discretionary stocks have done on a relative basis extremely well on Friday the 12th, and you've got to point. If you're going to ascribe any meaning or causation to that, it's got to be the strength of the consumer in the data this week, and the fact that the naysayers about the effect of low gas prices on consumption, I think we're proven wrong once again. This is a fantastic thing for consumers to be able to consume energy as a smaller portion of their discretionary budget. And so I think, there's every reason to expect that to continue. And once energy and material stocks, which have been punished pretty hard, find a bottom and people start seeing some value, then, as I say, I'd be pretty surprised if the equity market didn't calm down and if implied volatility didn't revert back lower to those means that we've been talking about. In terms of work coming ahead, we did a retail sales piece after Black Friday that kind of called Black Friday data noise and showed some of the upside. We've actually started putting out a daily flow note for clients that shows some interesting trades that went up in our neck of the woods, as well as some comments from me and variant swap levels and some other data of interest. And then I'm actually working on a 2015 outlook that hopefully will be ready before the end of the year with just some things I won't even tease, but I think some interesting ideas and strategies and expectations that people can look for.
Good stuff, Mr. Jared. And Mr. Andrew, what's your outlook for the rest of the year here from a vol perspective, or at least for the coming week, and as well as what's coming down the pike in the land of the pit?
Coming week, I think we might see one more tick higher in vol, and then it should subside, but I still think there's a lot of third emerging market dislocations. There's all those funky high yield dislocations. We've got the Fed basically coming out with a policy statement, which will probably be their biggest one in a while, on if they, change some language about raising rates a little bit, which I think they're going to do. They're going to roll right through all the rest of this and just declare victory and start hinting that things will happen in 2015. And I think the market, there's still a little bit of that will cause a little volatility. So probably get a little pop up in vol. Of course, that's right on VIX expiration day. Everything will expire in the morning, which could mess with the settlement a little bit if we have a little more action in the options if there's some worry about that. And then, probably seeing vol subside by the end of the week to some degree. But I don't know. I feel like this is not over quite yet. Whatever has been causing this little mess is not quite going away.
Indeed. Good stuff, both of you. And, of course, good stuff to all of you out there in the listening audience. And we want to thank all of you for downloading and streaming and subscribing to the show as well, for sending in such great questions. Keep Jared on the end of his rope. We like to hear that. And we'll see you next time right here on Volatility Views.
Thank you for listening to Volatility Views, the premier program for volatility traders. For episode archives and detailed show notes, please visit theoptionsinsider.com/volatilityviews. Be sure to make your own voice heard by leaving a volatility voicemail at 773-669-4VOL. or by posting a comment on theoptionsinsider.com, sending an email to questions@theoptionsinsider.com, or posting your questions to twitter.com/options or facebook.com/theoptionsinsider. Volatility Views is brought to you by Russell Investments, a global asset manager and one of only a few firms that offer actively managed multi-asset portfolios and services that include advice, investments, and implementation. For more information on Russell indexes and RVX, please visit russell.com/indexes.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions@theoptionsinsider.com.